the Opportunistic Trader for Monday, August 6th. I hope everybody had a nice weekend. We are very focused this week. There is not a lot of news, but there are definitely going to be a lot of trades. And this morning, there's been a lot of action. So we're going to look at the landscape here. What we're very good at with our experts is discerning trades and thoughts in all different markets along the global macro landscape. So it's time to go to work, and we're going to look at a recap overnight and go through all the markets. Good morning. Let me recap by starting out with the trade that we took into the weekend. We were short the 1835, 1845 call spread, and the market went out at 1839, which made us short the futures, which we hedged with a upside call to eliminate unlimited risk to the upside. We will today look to trade around that position and utilize the options that expire for today. Overnight, what I saw was a weak Asia again, following the theme. The Chinese market closed lower, as well as Hong Kong and Japan. And following up into Europe, when I woke up this morning, those indices were lower, anywhere from 50 points on the DAX to 30 points on the FTSE. At about 6:30 a.m., there was an announcement out of the EU about blocking U.S. sanctions on Iran. So the DAX immediately turned and went up about 150 points quick, about 1% and change, and the dollar strengthened. Maybe that caused the move to accentuate. Interestingly, off of that, oil rallied about 60 quick cents, hovering around the highs, up about $1. Across the debt sector, U.S. debt is sort of flat, down a couple of ticks. Gold continues its trend lower, and that's sort of the recap of the overnight. And today we're going to be looking at the S&P options to make some trades. The straddle, which we use every day to price in movement, is pricing extremely low. It's pricing at about $7.50 of move on the S&P, which is less than 40 basis points, which is very, very little. Obviously today and most of the week there's not a lot of news, so I guess this is like the dog days of summer. So we'll keep an eye on that, and I'll throw it over to Vince for his update.
Good morning, Larry. Thank you. Just to wrap around the world really quickly, if you're focused on here's the latest in the yuan trade wars with the U.S. On Friday, China basically raised margin rates, prohibiting or restricting shorting of the yuan, and it strengthened. At the end of the day on Friday, you saw a surprise rally or drop if you're looking anything that was dollar related on the industrial side. So gold rallied. I had a report out last night describing this. Platinum would be the leader if we did rally. So all is good going into the night last night. And then the market really does nothing on top of it, as you said, Larry. Uh, the controls don't work. They are reminiscent of 2016. China did the same thing. We might be repeating history again here. Then China comes out on their state blog, which I guess would be their form of Twitter, saying, we're not backing down. I guess the expression would be kowtow. And the result is not good. Metals reversed, the dollar strengthens, the yuan softens, and then we roll into Europe. And as you said, as you're making your coffee, the DAX is down on the back of HSBC and other bank earnings being very weak. And as you're drinking your coffee, the DAX does 150 point turnaround on EU saying they're going to ignore US sanctions. So basically, it's event-driven trade war type of stuff as we go into the US. Oil, we were discussing off air, Larry. If U.S. dollar-based assets are dropping because of lack of Chinese demand, how the heck is it that oil remains where it is? Well, we have our answer. It's you know, as you just said, it's based on the trade sanctions. It's based on international, macro, global events. Oh, by the way, I want to turn to bonds. Jamie Dimon made a comment yesterday. Do with it as you will. He thinks yields are going to 5%. I don't know where he pulls that out of, but a lot of analysts have been calling for 4%, probably managing expectations. We still have a hard time getting over 3%, as you alluded. So we're in it for the long haul with a protracted trade war. Metals will still focus on that. The bond markets will focus later in the week on the Bank of Japan's comments on their own bond market. And the equity markets are breathing rarefied air. I have no trades on the radar today in my focus, which is in metals, but there's certainly a lot of opportunity out there. All right. Can you hear me?
You were in and out, Vince.
Hello?
Yeah, you're in and out.
Oh, sorry. Am I clear now?
Yeah, you're perfect.
Okay. The S&P, you know, as fund managers try and, you know, as a guy who managed as much money as you did, if everybody is trying to basically mirror the S&P and the breadth of the market is narrowing, how do they keep pace if they start rolling out of techs? Like, what's left to go into for them?
It's
You know what I mean?
yeah, it's an interesting thought, and it's funny. You must have been reading my mind because I was sitting here, you know, just looking at actually the S&P at these levels, and you know, it's been a bit of time, and it just seems to be the same mantra pretty much all the time. Which is different than we were trained on in our careers that have been, you know, very long. It seems like there are buyers at the top and sellers at the bottom. And in between, depending on the day, you know, if the market's weak, everyone's selling. And then, you know, when it comes back, everyone has to cover. And it's interesting to me. And I'm just, you know, I was reading some stuff over the weekend and doing my research and all of that. And it just seems to me at these levels, about 1% from the all-time high, that every single thing that I've read is bullish. And, you know, I'm not debating whether or not we will hit an all-time high or we won't, and this will be the top. That, you know, is yet to be decided. But it's just interesting to me, you know, going back and sort of looking at the year per se. You know,
Right.
we started extremely strong, you know, then everybody put those long vol trades on against everyone that was short vol, and then they blew everyone out of the building in February. And once again, year over year, we always come back to near on the highs. And it's strange to me because I think we discussed this a little bit last week offline, but if we stayed down and we stayed down for a couple of weeks or a month, I think you would see, you know, a different marketplace. But what ends up happening is people are behind the eight ball, and they always have to buy. And it's easy when the largest companies in the world are doing massive buybacks, and really the entire game is in 10 stocks. And if I look at the stocks that I would want to maybe hold for years and years and years, those stocks are obliterated. And, they're down anywhere from 10 to 20%. And they're the bellwethers outside of technology that you would want to own. So to me, looking at the market here, it's obviously August 6th. So, you have seasonality and you have no one around and all of that. And potentially we could make a new high. I don't know if we will. But, in general, people have, once again, forgotten the risks in the tape, and, it could create a really good trading opportunity here in the next few weeks coming into the beginning of September. So, I'd like to keep an eye on that. But, thinking about the S&P, which is really my forte and what I look at, it's, it's amazing. Last week, looking back, we traded down to like the low 90s. I think it might have been Tuesday, and that would have been this last week. I think put us up 5 or 6 weeks in a row, and literally, if we stayed down there, that would have taken out 4 weeks of gains. So really, anyone that had bought, if we stayed down there, would have been down money if they bought over the last 4 weeks. So, to me, that's the interesting thing. So, I'll keep an eye on that. And do you have any thoughts on that as well?
Well, I have a question. I'm not sure, and based on the products that I focus and specialize in, I want to see if it applies to the S&P, and because I'm looking at that. Because let's face it, if you're trading metals, as I am, my levels are there. 1229 is important, and unless we get above that in gold, you should be short. But focusing on the S&P, if as we go higher, well, in general, as you approach all-time highs in a market that's got a narrowing breadth, used to be 100 stocks that everyone owned. Now all the institutions, basically, to exaggerate or simplify, everyone's long Apple. So your breadth is narrowing as we rally, and the volume is light up top there. It's been my experience that when you reapproach light volume highs in other markets, you would be inclined to short that because of the lack of confirmation. And the problem that I have run into, and I think beginning traders should take note of my losses for their gains, is that I have been right to sell in thin markets that make new highs, but there's also nothing to stop them from skating through it either. My point is, we come to new all-time highs on light volume. Are you shorting this with a tight stop, or are you waiting to sell weakness, or are you going to buy strength? If there was a gun to your head, what would you do if you had to do something?
You know what? Literally, I'm waiting here. What's good about what we do is we're patient. We don't have to make the trade, but the gun to the head trade for me is I would wait a little bit in here to see a failure and then short it. I personally like to trade by putting a position on and then utilizing stops to actually enter to get a little bit bigger, and then obviously using stops on all trades to exit if they don't work out. But at this level, I don't see much. I'm shocked at the pricing of the options, at how low they are, both for today and for the week. It's interesting to look at, but, I think, everybody's bullish up here again. So if we don't get a quick move, maybe, we'll get some topping action in, 5 weeks or 6 weeks in a row that are up. That would be, that would be overextended in my book. So
a suspension of reality,
for sure. But listen,
just a quick note to first time or non 50-year-old traders like ourselves. gun to your head is basically an indifference trade. You have to make a choice. We know you're not going to make a choice, but if I told you you had to jump in a pool of acid or slide down a railing of razor blades, what would you do? Well, I would shoot myself. I don't want to do either of those. But the point is, if you had to have a bias, what would it be? And what Larry is saying and what I was asking is, obviously we're going to be flexible when those levels come, but all things being equal as they are, if I were forced to make a trade, I would do X. And no one is forcing anyone to do anything right now.
No, for sure. And what makes us unique is we're, as the name says, opportunistic, and we're waiting to jump on opportunities that we think look really, really good. And what we put together here, in my mind, is a special product in the sense that I have 15 to 20 experts across the board scouring equities, fixed income, commodities, even cryptocurrencies, in case there are opportunities there. And we provide education and information that I think is very, very worthwhile to someone that is new in the business, to somebody that is an expert. And I'm providing, as well as you and a number of our experts, are actual trades that we're doing with the methodology of what we're thinking. So to me, I think that that's really a value add, and we don't have to make a trade if we don't see it. Obviously, we make tons of trades. I probably make anywhere from 20 to 50 trades a day on busy days. So, we'll be here doing it, but on a day like this morning, there's not a lot going on. We're looking obviously at trades and different things. And, to me, I'm not, an oil guru such as yourself. I mean, a gold guru such as yourself, but I'm looking at gold here, and it's kind of looking interesting to me. I'd like to see him hit some stops in here, and then maybe it could be a long for a bit of time, because I think that it's been a big move, very big move, but it's kind of not accelerating, to the way that I'd like to see it. So I think it would be interesting maybe to look at gold, potentially to the long side. Do you have thoughts on that?
Yeah, actually, I do. And we put out a report last night, but in summary, there's two factors that really are keeping gold down. One is the protracted trade war. Gold traditionally, if you want to look at a currency pair, focuses on the yen. Right now, it's focused on the yuan, as it did in 2016 when there were problems with the Chinese yuan and they were capping shorts there. So gold has the trade war keeping it down. Gold has, second, it has miners that have completely mismanaged their hedge book. More news is going to be coming out on that. Goldcorp, one of the top 5 miners, did not manage their hedge book properly, and they've probably been selling into weakness. That means other miners will. This demoralizes the investment community that want to play on gold. Now, that doesn't mean it's not a good trading vehicle. To your comment about selling it versus buying it, all the factors that matter to buy gold are there. What lacks in a market like gold, as opposed to a market like oil, is the catalyst. There's not a lot of urgency. Gold is one of those overnight successes. It does nothing, it does nothing, it does nothing until it's too late, and then you have this tipping point. Specifically to your point, we are below, if you're a technician, we're below every line that matters. We could plummet to 1140. I'm not comfortable selling weakness at these levels, but I will, I will buy puts to do that. In terms of rallies, I would be a seller of strength below 1329. If we get above 1329 or any decent volume, I think you're going to see the shorts come in heavily. The only definitive positive thing I can say is on Thursday, a player came in buying platinum and selling gold. So people are looking at metals again. On Friday, all the metals were up. I think you're wise to swing trade or trade the range in gold if you must. If you're going to be long, then look for a 2-week to 6-month holding period. If you're going to be short, play short and keep your finger on the stop button tightly right now. Otherwise, it's more fun to trade the S&P and it's more fun to trade oil right now. But the bigger play, I think, over the next 6 months will be a gold move, possibly led by platinum and or silver. I hope that helps.
No, that was great. Interesting. Bryn is on our chat now, and we're discussing volatility and volatility on the equities. And, obviously the vol is annihilated. It's in the 11 handle, which is shocking to me after how high it got in February, March. Obviously, that's a sign of complacency. That's a sign of people, choking on their long volatility. And, my personal opinion, and I don't know if you have thoughts on this, is especially in this year, anytime vol gets into this area, I think it's a buy. You might have to sit on it for a week or two, but interestingly enough, on Tuesday when we made the low in the S&P, the volatility index hit 14.5, which for that day was up 13 to 15%, and the S&P futures were only down 13 handles. So to me, people hate owning this vol, and it's painful, and I've done it before, and it's the ultimate pain, but it could pay dividends, especially coming out of August into September and seeing the lack of people that own out of the money puts to hedge their risk. And it's funny, I used to hedge the firm risk when I was at Spear Leads, which was a large specialist firm on the exchanges, but we had huge proprietary trading. We were probably one of the biggest around, but we would have a big book, and my job was really to figure out the best ways to put on hedges against long positions and short positions. And it was an unenviable task because in a way they needed us to lose on the hedge. So the guys or girls that are hedging, hedge fund books and firm books, it's not a great job, but it definitely pays dividends and saves you in times of crisis.
I can speak to the vol thing if you don't mind. Very, I think, hopefully succinctly, that would be of value to beginners as well as experienced players. The vol up here, as low as it is, first of all, the stock market is dominated by producers. And by producers, I mean funds that are long. Funds that are long naturally put on collars, or what's called risk reversals, where they buy put and sell call. Now, most of us as professionals know that. What's happened, though, is as we are reaching new highs, you're seeing more and more call sellers to create dividends for their long positions, but they're not buying puts until they have to. So that's one of the reasons that vol is getting smashed even more so than usual. So on a risk reward basis, what ends up happening is when the market does sell off, you get them buying puts because they have to, not when they wanted to. The result will be they get lulled. Long fund managers get lulled into thinking there is continuous liquidity or constant offers for puts on the way down. Some would be put on tinfoil hats and say, well, that's the Fed making puts cheap. But the reality of it is this: volatility is cheap up here. It is not necessarily bearish that it's up here, that everyone's complacent. What it does mean is that everyone's comfortably long and selling calls, and they're not buying as many puts as usual. It does imply to me that if we do get a sell-off, it will be violent because the volatility of volatility will blow out. If you're a vol player, yes, it's a good time to buy puts on the simple side. If you want to play sophisticated, the secret weapon of a bear in the stock market is buying a hedged call spread. If the market drops, volatility will explode. If the market rallies to your shorts, volatility will come in. And that's the way I would play it, and I have played it before in this market. Options are a buy because the people who need to buy them are not.
No, that's interesting thought. I would add a little antidote in the fact that, I've been doing this for a very, very long time, and I actually have made a lot of money on the short side of options, short dated, premium. It's very interesting. As an active trader myself, inherently, I want to be short dated volatility, because my thought always was that if things got crazy, I could always hedge my risk, but it would create amazing trading opportunities. And if we had potentially a day like today that looks very, very slow, I would be able to take in a little bit of premium, finance positions that I had on, and move, to the next day or a period of time that I put the
Right.
short premium on. And as a active trader, in a way, it's not a bad thing to look to, sell options hedged. I would always sell a put or a call and buy something lower down in puts to hedge the risk, and have a short put spread or a short call spread, which you've seen me do over the last
Right.
week. And
Agreed.
it works out pretty well. And then hopefully when we have a move, that there'll be good enough trading to finance, the positions.
Exactly. To put it very clearly, if you're a fund manager and you're long Apple, every rally that comes, you will sell calls or roll short calls higher to create a dividend. If Apple's trading, I don't know, 500 or whatever the price is, I don't even care. You're going to say, I'll sell the 550 calls. I'd be happy to have the stock taken away from me at 550. And then you're also selling that call to finance, as you just said, some insurance on the downside. Why do you buy that put? Because the end of the quarter's coming. You want to make sure you can take your payout. So these fences, collars, or risk reversals are the modern version of portfolio insurance. That's why, to use an option Greek phrase, or geek phrase, I should say, the stochastic processes of volatility in stocks leads to a put skew. Dominant players buy puts and sell calls. The interesting thing is, and this is a function of greed, and I see Bryn typing to that point right now, is that they're sure selling calls in the rally, but they ain't buying puts as much as they used to. They're trying to goose returns. And, that always ends in a problem that's lately been bailed out by the Fed. So that's basically it. If you're a fund manager, you are buying puts and you are selling calls all the time. I just don't think that they're buying as many puts. The skew to options guys tells me that, and the volatility itself tells me that. The complacency may be warranted because the catalyst to send them lower may not be there, but the complacency is just a great risk reward opportunity for long players on the long side.
But I think, looking at that, interestingly, a lot of the problem, or a lot of the reason for that I see, is the returns haven't been great, and people don't want to risk percentages of their return on the year. So, like, we used to look at it, when I was running a lot of money, if we wanted to hedge, we would spend a certain amount per month, on option.
Right, it's
premium.
insurance.
But what's happened is, if the S&P is up about 5.5% and you're up 4, you don't have the leeway to lose 40 basis points for the month, or 30, or whatever the basis points are that you're hedging your long positions with. So people are leaving that part of it out, taking a little bit of undue risk in the environment, and hoping, that the big one doesn't come. you saw a lot of that.
You know,
You saw a lot of that scramble in February. Other than them blowing up volatility
but that's
products.
spot on. That's spot on. The active managers are under such pressure to perform now that they're cutting costs any way they can. I mean, they're getting dot matrix printers. They're firing people. They're like, we won't buy puts. We just hope it goes higher. Yeah, that's spot on. I mean, they really, really are shaving costs, and they're not buying insurance. I think that's an important point.
Now that's what I see. Overall, the market's firm, but like I said before, higher prices bring higher prices and lower prices bring lower prices. If we were 35 handles lower right now, the market would be a little iffy, but we're in, as you said, rarefied air, close to the highs. So it'll be interesting to see how things progress today. Again, it doesn't look busy. Obviously, that can change on a dime. We'll keep you up through the day on the trades that we're looking at. Today on tap is basically the Philly Fed at 9:45. We don't think that's really going to be too market moving, but we'll keep an eye on that as well. At 12 o'clock today, we have Mark Fisher coming on, who has been a mentor to me through my career. He's probably one of the most, if not the most talented trader that I've come across in my career, and has been on TV very many times on CNBC. They sometimes refer to him as the king of oil. His insights into natural gas and oil are amazing, and I'm looking forward to him coming on at 12 o'clock. And then today at 1 o'clock, we have Adam Collins, who is a younger trader, does a lot of amazing research on data that is very important to the trading community, as well as research. So it'll be very informative to hear from him at 1 o'clock. And those are my thoughts for this morning. I don't know if you have anything else, Vince, but it's been...
Larry, we could go back and forth and talk options all day. Maybe we should have a seminar or a webinar on the side. It's 8:33 now. I think I know that you want to start focusing on the stock market, and I'm going to do a metals report.
Okay. All right. So
I think
we will be back to you at 8:45. Greg is going to come on, our FX expert, and he's going to go over the currency markets. That is a really, really good mover today, and I think you'll get a lot of insight from him on that trade, and I'm looking forward to hearing from him at 8:45 with trade
of the A down, B up, C down system that I still use to this day. I look forward to it, Larry. Thank you.
Me too. Thanks a lot. We will talk later.